Welcome students on video lecture initiatives of Board of Studies of ICAI. So this is a video lecture on Accounting Standard 13, Accounting for Investments of Chapter 1, Accounting Standards of Paper 1, Accounting of CA-IPCC Curriculum. I am CA Alok Kumar Garg, your mentor for this lecture. Accounting Standard 13, Accounting for Investments. So this standard is important from real life as well as from examination perspective. So this standard is applicable for the accounting period beginning from 1st April 1995. So no organization in this world can, if the prospect of that organization is run forever, or if the organization is having a long-term perspective, that entity or that enterprise will make some saving or investment. So this standard specifies that how those investment needs to be accounted and disclosed. So the students can expect a case study or a practical questions from this accounting standard in their CA-IPCC. Now coming to the agenda of Accounting Standard 13, so we'll see what we are going to learn in this standard. So the first thing is objective and scope. So objective means why this standard is issued and what should be the parameters of the standard. What should be the diameter of this standard. Key definitions. So we will learn some important terms used in this standard. Then classification of investments. So how investment is going to be classified and presented in financial statement of an entity. Then cost of investment and carrying value. So how the cost of investment can be measured initially and how is it going to be valued subsequently, that is at the reporting date or at balance sheet date. Reclassification and disposal of investment. What should be the accounting treatment in case of reclassification? So if the entity is shifting its investment from one classification to another classification, so what should be the relevant treatment and disclosure, and how the disposal of investment needs to be accounted for. Then coming to the disclosures which an entity has to make for the better presentation of financial statement. So coming to the objective and scope. This standard deals with accounting for investments in the financial statement of enterprises and related disclosure requirements. So there are only two agenda which is given in this standard. So the first agenda is to accounting. So how to account for the investment, and the second agenda is disclosure requirements. So the first one is how to account and the second one is how to present and disclose. So this standard tells an entity about how to account for the investment and how to present and disclose the investment. It does not deals with basis for recognition of interest, dividend, and rentals earned on an investment. So this standard is dealing with investments, but it does not deal with interest, dividend, and rentals which are earned from those investments. Because for interest, dividend, and rentals, Accounting Standard 9 specifies the treatment. Accounting Standard 9 is on revenue recognition. Operating or finance leases. So this standard does not specify the treatment of operating or finance leases because the treatment has been given in Accounting Standard 19 on leases. So investment of retirement benefit plans and life insurance enterprises is also out of the purview of Accounting Standard 13. This standard is also scoped out, or this standard also not dealt with mutual funds and venture capital funds and or the related asset management companies, banks and public financial institutions which are formed under central government or state government act or so declared under Companies Act 2013. So this standard is not applicable for this part, for leases, for investment of retirement benefit plans and mutual funds and venture capital funds. Now coming to key definitions. So the first and foremost important definition is definition of investments. So this standard is the name of this standard, or the title of this standard is accounting for investment. So we have to understand what is meant by investments. Investments are assets held by an enterprise. So these are assets held by an enterprise for earning income. So keyword is for earning income by way of dividends, interest, rentals, capital appreciation or for other benefits to the investing enterprise. Asset held as stock in trade are not investments. So going by the definition, the purpose of investment is earning income, and the form of income is, so here purpose of investment is earning income, because the definition is investment are assets held by an enterprise for earning income. So the intention and purpose is earning income. And what are the sources on what are the form of income? So form of income could be interest. So the entity has purchased, or the entity has made an investment in debentures, fixed deposits, government securities. In such case, the entity will receive interest income. Or the entity has invested in preference share or equity shares of another entity, like entity A has acquired shares of Infosys Limited, Tata Motors Limited, Reliance Industries Limited, Bharti Airtel Limited. So it can earn dividend from those investments, those shares. Or rentals, the entity has invested in land and building, so the entity is getting rentals on those land and buildings. Capital appreciation, so the entity has invested in shares, the entity has invested in land, the entity has invested in building for the purpose of capital appreciation. So these could be the form of income. So now again repeating the definition, investments are assets held by an enterprise for earning income. So the purpose is, the intention is to earn income. And what are the form of income? By way of dividend, interest, rentals, or capital appreciation, or other benefits. Asset held as stock in trade are not investments. So investment are something which is not comes within the operating activities of an entity. So the entity generally makes investment out of the surplus funds from its operations. But let's say the entity whose business model is to earn income by way of trading of investment. So the, like a property dealer, like a builder. So the builder used to purchase the property and sell those properties. The builder is making money or making profit by way of purchasing or selling those land and building. So these land and building is not an investment for that builder. Rather, these land and building are stock and trade for that builder. Second, like security house, or any company which is engaged in the business of trading investment. So the intention of that entity or the business model of that entity is to purchase investment and sell investment on a regular basis. The entity is trading in those investments, in those shares. So those shares is held as a stock in trade for that entity. Those assets are not investment for that entity. So the basic fundamental is, what are the primary activities by which an entity is getting a bread and butter? So what are the primary activities by which an entity is generating revenue? If the primary activities, if those items or those assets by which the entity is primarily getting or generating a revenue, then those items could not be investment, rather those items could be stock and trade or something else. Now coming to form of investments. So investments is generally not having a physical existence, like equity shares. So equity shares are nothing, it's a certificates, like fixed deposits. So whenever you are doing, or you are making a fixed deposit with the bank, so the bank will give you a certificate. So at the time of redemption, you have to submit the certificate to the bank, and the bank will credit the money, or the bank will refund the money to the depositor. Coming to the debenture, again debenture is a certificate. So coming to the government securities, again it is a certificate, national savings certificate, so Indira Vikas Patra. So these all are certificates. So normally investment is not tangible in nature. Some investments are tangible in nature, for which active market exists, like land, building. So these are considered as an investment property. So these are tangible in nature. The form of income is dividend. So what could be the form of investment for earning this dividend? It could be equity shares, it could be preference shares, So the entity can earn dividend in equity shares or in preference shares. Interest. So on which investment entity can earn interest? It could be fixed deposits, it could be debentures, it could be government securities like national savings certificate as well, it could be bonds like there is a NHAI bonds, National Highways Authority of India, RECL, Rural Electrification Limited bonds. So there are a lot of bonds which has been issued by the government or public enterprises. So they will give a fixed amount of interest. So these are the form of investment on which an entity can fetch an interest income. Rentals, on which form of investment the entity can earn rentals. So the entity can earn rentals on land, on building, which is considered as an investment property with the purview of this standard. Capital appreciation. So the entity can hold its investment for earning capital appreciation. So which could be the form of those investment on which the entity can expect or can hold for capital appreciation. So it could be land, it could be building, it could be shares, etc. So these are the form of interest. These are the form of investments on which the entity can earn dividend, interest, rentals, capital appreciation or other benefits. Now coming to key definitions. So in this standard, the fair value term is used at a lot of places. So let's understand what is the meaning of fair value. So fair value is something which a seller could fetch while selling its asset in open market. So if I say a word market, so the amount which a seller would fetch in the market. So the basic presumption is the transaction should be between a knowledgeable seller and a willing buyer. So the buyer is knowledgeable. If the buyer is going to a market to acquire something, acquire an asset, then it is considered or assumed that he should be knowledgeable and willing. And selling an asset in the market, it should be at arm's length transaction. So the market is open for everyone, it is open for seller, it is open for buyer. So the price at which the seller is selling its product between a knowledgeable buyer and a willing buyer and under an arm's length transactions, it should be considered as a fair value. So what is the meaning of arm's length transactions? The arm's length transactions means the unjustified or unreasonable benefits should not be passed upon. Like a person is selling its property to his brother. The value of the property is 90 lakh rupees and he is selling its property to his brother at 80 lakh rupees. So it is not at an arm's length transactions. Second thing is due to coercion or under a gunpoint, an entity is transferring its asset to another entity at half of its price. So again, it is not an arm's length transaction because it is due to the fear and it is due to the coercion of somebody else. So coming to fair value definition, going by the standard, fair value is the amount for which an asset could be exchanged between a knowledgeable and willing buyer and a knowledgeable and willing seller. So the seller and buyer both are knowledgeable and both are willing. Seller is willing to sell and buyer is willing to buy in an arm's length transactions. So the transaction is free from all the nexus. Under appropriate circumstances, market value or net realizable value provides an evidence of fair value. So under a proper mechanism, the market value or net realizable value of that item provides an evidence of fair value. So it is normally a value on which a knowledgeable and willing seller can sell the asset to the knowledgeable and willing buyer under an arm's length transaction. So market value is the amount obtainable from sale of an investment in an open market, net of expenses necessarily to be incurred on or before disposal. So market value means the value or a price which can be obtained from the sale of an investment. Like an entity is selling the 500 shares of Infosys in a secondary market at a price of 100 rupees. So 500 multiplied by 100 of 50,000 rupees. So while selling those shares, the broker is charging a commission of 1% or brokerage of 1%. So on that 50,000, 1% brokerage is charged. So 1% is 500 rupees. So the market value is 50,000 minus 500, 49,500. So the market value is the value which an entity could fetch by selling of an investment in open market, which is net of expenses necessarily to be incurred on or before disposal. So it is net of expenses. Current investment is an investment that is by its nature readily realizable and is intended to be held for not more than 1 year from the date on which such investment is made. We will learn this term in further slides. Again, long-term investment is an investment other than a current investment. So we will see these terms or items under classification of investment. So I am skipping for the time being. Investment property is an investment in land or building that are not intended to be occupied substantially for use or in the operation of the investing enterprise. I have to discuss this term as well in detail. So coming to classification. So investment is classified as a current investment and a long-term investment. So any kind of investment which an entity is acquired or purchased, or the entity is making any kind of investment, it has to be classified as a current or it has to be classified as a long term in the balance sheet of an entity. So let's understand what is the meaning of current investment. So as the word suggests, it is similar to current asset. Like current asset are those assets which is realizable within 1 year, or the entity is expecting or entity is having an intention to realize those assets within 1 year or less than 12 months is regarded as a current assets. Now coming to current investment. So current investment are those investment that is by its nature readily realizable and is intended to be held for not more than 1 year from the date on which such investment is made. So there are two keywords. So the first word is going by the nature, it should be readily realizable. Readily realizable. What is the meaning of readily realizable? The meaning of readily realizable means if the person or entity wants to realize those investment, it can go into market and it can sell off those shares. Like if I have purchased 100 shares of Reliance, I can sell those shares anytime in the secondary market between 9 to 3:30. So those shares of Reliance are readily realizable. So what could not be readily realizable? Let's say irredeemable preference shares. So although in India issue of irredeemable preference shares are not allowed, but let's say if irredeemable preference shares are there, so those irredeemable preference shares cannot be redeemed during the lifetime. So these are not readily realizable. Or any investment where there is restrictions. So there is a restrictions of the regulators, or there is a restriction of stock exchange, or there is a reduction of restrictions from the government, that these securities cannot be traded before 2 years or before, let's say, 15 months. So in that case, those investments are not treated as a readily realizable. So the first condition is, for being a current investment, those investments should be readily realizable and is intended to be held for not more than 1 year. So the second thing is intention. So the intention for holding those securities is not more than 1 year. So the second is intention. Although the securities are readily realizable, but the management does not want to sell those securities within 1 year. So the management is having a long-term intention for keeping those securities and getting the money realized from those securities. So even though the securities are readily realizable, but the management intention is to keep it for a long period, that is for more than 1 year. In such case, it is not a current investment. So that these two are accumulated, or let's say compounding cumulative conditions. So the first one is readily realizable, and second one is intention to hold for not more than 1 year. Not more than 1 year. So if the investment is meeting two criteria, the first criteria is it should be readily realizable, and the second criteria is the entity is having an intention to hold these securities for not more than 1 year from the date on which such investment is made. In such case, these investment will be classified as a current investment. What is a long-term investment? Any investment which is other than a current investment. Example, the Reliance shares, Infosys shares are readily realizable in the market, but the management wants to hold these shares for capital appreciation purposes for a period of 5 years. So in this case, it is a long-term investment. Or although intention of management is not keeping those shares or not keeping those securities for more than 1 year, but the investment is not readily realizable or investment is not realizable within 1 year. So in such case, these kind of securities or investment will be classified as a long-term investment. So an entity has to classify its investment either as a current investment or a long-term investment separately in the balance sheet. Now coming to classification of investment case study. So let's understand the classification by the help of some examples. X Limited purchased some shares which can be sold or transferred after 18 months due to some stock exchange restrictions, and the entity wants to sell it in near future. So the intention of the entity is to sell off those shares in the near future, but the shares are not readily realizable due to some stock exchange restrictions. The company can sell these shares only after 18 months. So in such case, it is not a current investment, it is a long-term investment, LTI. X Limited also buys some debentures which are readily realizable, so X Limited can sell off those debentures in the market, but the intention of the management is to keep these securities at least for 1 year 3 months. So the first condition, readily realizable, immediately realizable, is there, but the intention of the management is to hold these debentures for more than 1 year. So in this case, again, it is a long-term investment. So it is not a current investment. X Limited purchased some government securities which are tradable in secondary market. So X Limited can sell off those securities anytime, whenever it wants, and entity want to dispose of the same within 3 months. So the first thing is it is a readily realizable, and the second thing is the intention of the entity is to sell off these securities less than 1 year, so within 3 months. So it is a current investment. Now coming to cost of investments. So investments could be acquired in a different ways, in a different manner. So the first thing is investment could be purchased by paying off amount. Investment could be exchanged. So let's say entity X is getting a P investment in consideration of transferring other assets of Q asset. So it could be in the form, it could be by way of consideration of cash, or it could be by way of a barter system. So entity is surrendering its one asset in return of acquisition of another asset as an investment. So what should be the cost of investment? What should be the first accounting entry? At what value the entity has to pass for recording its investment? So the first thing is investment purchased. If the entity has acquired investment, then the cost of an investment includes acquisition charges such as brokerage fees and duties. So let's say I have purchased 100 shares of Infosys Limited. So the cost of those shares is 1000 each. So the cost of 100 shares is 1 lakh rupees. For purchasing those 1 lakh rupees of shares, I have to pay a brokerage of 1%. So the brokerage is 1000, and I have to pay a stamp duty of rupees 500. So the acquisition charges, which is 1 lakh rupees, the price of the cost of investment, which is 1 lakh rupees, and acquisition charges such as brokerage fees and duties should be combined with the cost of an investment. So in my case, the cost of investment will be 1 lakh rupees plus 1000 rupees of brokerage and 500 rupees of stamp duty. So my cost of investment will be 1,1500 rupees. So I have to debit investment in equity shares of Infosys 1,1500 to bank account by 1,1500. So in case of investment purchased, The cost of investment will include cost as well as the acquisition charges. So the second form is investment acquired by issue of shares or other securities. So the entity has issued its shares and acquired another investment in return of issuance of shares. So in such case, cost is the fair value of the securities issued. So what is the meaning of fair value? Fair value means the amount or a transaction when it is incurred between a knowledgeable and willing seller and a knowledgeable and willing buyer at arm's length transaction. So the entity has issued its 100 shares for getting a building of rupees 20 lakhs. So the cost of that building will be fair value of the shares issued by the entity. So the fair value of 100 shares which the entity has issued for acquiring that building will be the cost of that building. So let's say the fair value of 100 shares which the entity has issued for acquiring that building is rupees 15 lakhs. In such case, the cost of building will be 15 lakhs. So the accounting entry will be building which is an investment property will be debited and shares will be credited. So the difference between the value of the shares and the fair value of the shares will go to profit and loss account. So the third form is investment acquired in exchange of another asset. So the first example was crystal clear. The entity is paying cash for acquiring investment. The second example is the entity is issuing its investment for acquiring another investment. So the entity is issuing either shares or securities. So the third one is investment acquired in exchange for another asset. So the entity is giving a machinery in return of acquiring an investment of, or let's say 500 shares of another entity. So in such case, the cost is the fair value of the asset given up. So like in the previous example or previous case, so we have seen that the cost is the fair value of the securities issued. It means fair value of the securities given. So again in this case, the cost of the investment acquired will be the fair value of the asset given up. It may be appropriate to consider the fair value of investment acquired if it is more clearly evident. So let's say between the between the fair value of the asset given up and the fair value of investment acquired, if the fair value of investment acquired is more visible, more clear and more evident, in that case the entity can use the fair value of the asset acquired. Otherwise, fair value of the asset given up will be used as a cost of the investment acquired. Coming to the cost of investment case study, Jupiter Limited buys 2000 shares of Pluto Limited at the rate of rupees 100 per share. So Jupiter Limited has acquired 2000 shares of investment at the rate of 100 per share. So the cost of investment is 2000 multiplied by 100, 2 lakh rupees. And Jupiter is also paying a brokerage at the rate of 2%. So it is paying a brokerage of 2% and stamp duty of rupees 5000 on 1st April 2017. So apart from 2 lakh rupees, Jupiter has to pay 2% of brokerage to the broker and stamp duty to the government for rupees 5000 on acquisition of these shares. What is the per unit cost of shares purchased by Jupiter Limited? So this question is asking for the per unit cost. Further, Jupiter Limited intend to keep these investment for 6 months and utilize the money for some predetermined objective. So the question is also saying that the Jupiter wants to keep this investment for 6 months only, which is less than a year, and utilize the money for some predetermined objective. Advise the accountant of Jupiter to how to classify these investments. So coming to the particulars. So cost of shares, Jupiter has acquired 2000 shares at the rate of 100 each. So the amount is 2 lakhs. Brokerage is at the rate of 2% of the transaction price. So it is 4000 rupees. And the stamp duty was rupees 5000. So stamp duty of rupees 5000. So the total cost is 2,09,000. So the question is asking for the per unit cost. So number of shares 2,000. So per unit cost will be, so dividing 2,09,000 divided by 2,000, so it is 10 rupees and 45 paisa. So the per unit cost will be 10 rupees 45 paisa, and the accounting entry will be investment account debit by 2,09,000 to bank account. The question is also saying that Jupiter Limited wants to keep these investment for 6 months and utilize the money for some predetermined objective. Advise the accountant of Jupiter how to classify. So we have seen there are two kind of classification for the investment: current investment and long-term investment. For current investment, there are two conditions. So one is it should be readily realizable, and the intention of the management to keep those investment for less than a year. So here the intention is 6 months, which is less than a year, but whether it is readily realizable or not, word is missing. So we are assuming that it is a readily realizable and the intention is to hold these securities for less than a year. So Jupiter will classify these investment as a current investment in the balance sheet. So I hope this question is clear. So we have covered the cost of investment part, which includes brokerage and stamp duty as well, which is the acquisition charges, and we have also looked into the classification of investment. Now coming to the another area of cost of investment, interest, dividend and interest receivable in connection with an investment are generally regarded as income, being the return on the investment. So these are the income which is recognized in accordance with accounting standard 9, revenue recognition. So normally these, so when we have read the definition of investment, so we have learned that investment are those assets which are held to earn income by way of dividend, interest, rentals and capital appreciation. So in some circumstances, such inflows represent a recovery of cost and do not form part of income. For example, when unpaid interest has accrued before the acquisition of an interest-bearing investment and is therefore included in the price paid for the investment, the subsequent receipt of interest is allocated between pre-acquisition and post-acquisition periods. The pre-acquisition portion is deducted from cost. So let's take an example. The entity has purchased a government securities on 1st January 2017. So the entity has purchased a government securities on 1st January 2017. The government securities will give an interest at the rate of 10% per annum, and the due date for this interest is 31st March every year. This interest will be payable to the holder of the securities on 31st March. So whoever will be the holder on the date of interest will receive interest for the year. So the entity has purchased a government securities for rupees 10 lakhs. So the face value, the entity has purchased a government security for rupees 10 lakhs. The face value of those government securities is rupees 8 lakhs. So face value is 8 lakhs. So the interest will be, for interest for full year will be 80,000. So the entity has acquired this investment on 1st January 2017. So the last interest on this investment has been received on 31st March 2016, that is before 9 months, because the government will pay interest on every 31st March, and the interest will be given to a person who is holding investment at that point of time. So it means on 31st March 2017, the entity will receive interest for full year. So the entity is holding the investment for 3 months but will receive interest for full year. What does it mean? It means the entity has paid the interest of 9 months. 9 months from which period? 1st April 16 to 31st December 16 to the seller of this government securities. So 9 months interest will be 60,000. It means in this 10 lakh, 80,000 multiplied by 9 divided by 12. 60,000 interest is inbuilt in this. So it means the entity is paying 10 lakh rupees. So 10 lakh is having two parts. So one is 60,000 on account of interest which the seller will forego, and 9,40,000 for cost of investment. So the entity has to recognize investment account debit by 9,40,000, interest accrued 60,000 to bank account 10 lakh. So on 31st March 2017, the entity will receive an interest of 80,000 from the government. So in that case, this 60,000 will be the reimbursement of interest like. So the entry will be bank account debit by 80,000 to interest accrued 60,000 to interest income 20,000. So the criteria is, the crux of the story is the receipt of interest. The subsequent receipt of interest is allocated between pre-acquisition and post-acquisition period. So pre-acquisition period is 9 months, which is 1st April 2016 to 31st December 2016. So for pre-acquisition period, the entity has already paid 60,000 for acquiring those government securities. For post-acquisition period, that is for 3 months, 1st January 17 to 31st March 17, the entity will recognize interest income. So again, I am repeating an accounting entry. The entity will receive an interest for full year, that is 80,000. So the accounting entry will be bank account debit by 80,000 to interest accrued 60,000. Which interest accrued? This one which the entity has paid to the seller, and interest income will be credited by 20,000. So now again I am reading this last para. For example, when unpaid interest has accrued before the acquisition of an interest bearing investment and is therefore included in the price paid for the investment, the subsequent receipt of interest is allocated between pre-acquisition and post-acquisition period. The pre-acquisition portion is deducted from cost. Now coming to a case study on this. Sun Limited purchased 108% debentures and paid rupees 1 lakh to the seller on 1st October 2016. So number of debentures are 100. So number of debentures 100. The debentures are 8%. It means the debentures will provide a return of 8% in the form of interest, and paid rupees 1 lakh to the seller on 1st October 2016. So on 1st October 2016, paid 1 lakh rupees to the seller. The interest is payable to the holder of security on 31st March of every year. So the interest payable will be 31st March. So every year the entity, or let's say the issuer, which issued the debenture will pay the holder yearly interest on 31st March of every year. So whosoever, let's say if a person has acquired a debenture on 30th March, so he will get a full year interest on 31st March. Explain how this transaction accounted for on the date of purchase and on 31st March in the financial statement of Sun Limited. So the date of purchase is purchase. The date is 1st October 2016. So the interest period is 31st March every year. It means Sun Limited has paid accrued interest of for the 6 months which the seller has foregone. So the rate of debenture is 8%. So coming to the, let's say, as we are assuming that the face value of the debenture is rupees. Let's say we are assuming with the face value of the debenture is. So in this question, the face value of the debenture is given on which the entity will receive a interest. So we are assuming the face value is, let's say, 1,000 rupees. So the purchase price 1,000 rupees. So 100 multiplied by 1000, it is 1 lakh, and interest per annum will be 8%. So on 1 lakh interest will be 8000. So 8000 is for the full year. Then for 6 months it is 4000. So it means the entity, the Sun Limited, has paid 4000 to the seller on account of accrued interest. So the entry will be investment in debenture debit 96,000, accrued interest debit 4,000, to bank 1 lakh. Now the interest is payable on 31st March of every year. Explain how this transaction accounted for on the date of purchase and on 31st March. So on 31st March, the entity will receive interest. So the entry will be bank account debit. So it will be debited by 8000 to interest accrued, $4,000 to interest income 4,000. So basically the unpaid interest which has been accrued before acquisition has to be deducted from cost, and the receipt of interest needs to be allocated between pre-acquisition interest and post-acquisition interest. Now we are going to learn about the cost of investment in case of issuance of rights shares. So let's understand what is the meaning of rights shares. So a right issue or a rights share, right issue or rights share is an issue of rights to a company's existing shareholders which entitle them to buy an additional shares in the proportion of their shareholding. So basically, if a company, in case of a further subscription, if the company is giving a right to the existing shareholders to buy additional shares, normally it is in proportion to their existing shareholding within a specific time frame. Normally these rights are transferable and could be sold in the market, and the existing, in case of right shares or in case of right issue, the existing shareholder will get a discount in comparison to the market price in case of buy of those shares. So in nutshell, these right shares are issued to the existing shareholders in the proportion of their existing holding. The additional shares are issued at a discount or at a less price in comparison to which is given to the other participants or other market participants, and these rights are transferable. Existing shareholder, if does not want to avail those rights or does not want to subscribe additional shares, they can sell their rights to anyone else. So now we are going to learn how to account for the cost of investment in case of issuance of right. So there are two conditions. The first one is when right shares are offered for subscription and shares are purchased ex right. What is the meaning of ex right? Ex right means the existing shares, when the existing shares were issued, when the existing shares were issued, the price was ex right price. The rights were not inbuilt in those shares. It means the shares has been purchased before record date. If right shares offered are subscribed, let's say the company has offered rights to existing shareholders and the existing shareholders have subscribed those rights. So in such case, cost of the rights share is added to the original investment. So let's take an example. A is having an investment in equity shares of B Limited. So the cost of the original holding for 100 shares is 1000 rupees. So initially A has purchased 100 shares at the rate of 10 each. So the current holding or the earlier holding is for 1000 rupees. The cost of investment is 1000 for 100 shares. Now B Limited is offering a right to A Limited to subscribe additional shares at the rate of rupees 8. and the right given is 1:1. So a shareholder who is holding one share can have a right of one share, or have a right of one additional share. So entity A has availed its right, has subscribed its right, and purchased additional share of 100, and had purchased additional 100 shares for rupees 8 each. Now the cost of earlier holding is 100 multiplied by 10 is equal to 1000. The cost of right holding or the subsequent holding is 100 multiplied by 8 is 800. So the total is 1800. Now the investment is for 200 shares. So the cost of the right share, this 800 will be added to the original investment, and now it will become a share of rupees 9 rupees each. So the cost of 200 shares is 1800. So basically the cost of the right is added to original investment. As I have told you earlier that these rights are transferable and sellable in the open market. So coming to my example, let's say A Limited is having 100 share of 10 each in B Limited. A Limited has not subscribed the right but sold in the open market. So again the current value of the holding is 1000 rupees. So A has sold its right at the rate of 5 rupees in the open market. So the sale is 100 multiplied by 5, 500. So the cost of investment will remain as it is for 1000 rupees, and this 500 rupees will be credited to P&L account. So the entry would be bank account debit by 500 to miscellaneous income, 500 rupees, or income on account of sale of rights. Now coming to calculation of cost of investment when shares are acquired come right. So what is meant by come right? So come right means when the original shares are acquired or initial shares are acquired, the rights has already been announced. So basically the person or the entity has purchased those shares before record date, and the holder of the original shares who is on the record date or book closure date of the company will get those rights. So it means before record date the shares has been traded at a higher price. Why? Because an inherent element of rights has been inbuilt into it. So what should be the cost of investment when right shares are offered for subscription and original shares are acquired come right? So again, coming to our first example, A Limited has acquired 100 shares of at the rate of rupees 10 for rupees 1000 in B Limited. So those 10 rupees is come right price, and B Limited is offering a right shares of on the proportion of 1:1. So A is entitled to subscribe 100 shares, 100 right shares, 100 additional shares. So again, repeating my example, original holding is 100 multiplied by 10, 1000. So the rights is given for 1:1 at a 8 rupees discounted price. So 800. So in this case, the cost of the right share is added to the original investment. So the cost of original investment is 1800 for 200 shares. What if the rights are not subscribed but sold in the market? So here is the twist. Here is the difference between the X right calculation and come right calculations. So in this case, sale proceeds is used to reduce the carrying amount of investment. So why it is used to reduce the carrying amount of investment? Because when the entity has made an earlier investment, it has paid a higher price to enjoy the fruits of right. So in this case, let's say 100 multiplied by 10, 1000 is a portfolio, 1000 is the value of investment which A Limited has made come right. So A is selling 100 shares at the rate of rupees 5, selling 100 rights at the rate of rupees 5. So in this case, 100 multiplied by 5, this 500 rupees will be reduced from the cost of the investment, and the balance cost of investment will be 500 for 100 shares. So this will be the value of investment. So in X right case, that sale will be credited to P&L account. Here the sale proceeds will be reduced the carrying amount of the investment. Now coming to carrying amount of investment. So there are two terms used in accounting. So one is initial measurement and subsequent measurement. So initial measurement takes place at a transaction date, like A Limited has purchased some equity shares on 1st January 2017. So whatever accounting entry, whatever measurement A Limited will be applied, it will be known as initial measurement, which will happen on a transaction date. Subsequent measurement means measurement which will happen on the reporting date. Reporting date means, let's say 31st March, which is end of the financial year, or the date on which financial statements are going to be prepared. So now we are going to learn how to calculate the carrying amount of investment. So we have learned there are two kinds of investment. One is current investment and one is long-term investment. So what is current investment? Current investment is those investment when two conditions are satisfied cumulatively. So the first one is it should be readily realizable, and the second one is the company or management has an intention to hold these securities for less than a year. So initially the investment is recognized at cost. Cost includes acquisition charges as well. And what is the subsequent measurement of these investment? So the current investment will be carried at lower, the word is lower of cost and fair value. So it is very important concept, lower of cost and fair value. So let's say an entity has purchased 100 shares of Infosys for rupees 1 lakh on 1st January 2017. So each share cost rupees 1000. On 31st March 2017, the cost per share of Infosys is trading at, or is the closing value of Infosys share is rupees 800. So the cost is 1000, fair value is 800. So the entity has to carry its current investment at a lower of cost or market or fair value. So fair value is 800 multiplied by 100, 80,000. Cost is 1 lakh. So it has to be recognized, it has to be measured or carried at 80,000 rupees. So what should be the treatment of 1 lakh treatment of this 20,000 deficit? This 20,000 will go as a mark to market loss in profit and loss account. So this 20,000 will be debited to profit and loss. The accounting entry will be investment will be credited by 20,000, and under profit and loss, mark to market loss will be debited by 20,000. The second key concept is the valuation should be on individual investment basis, not on an overall or global basis. Let's say the entity is having a portfolio of investment in equity shares of 5 companies. The total worth of portfolio is rupees 1 crore. So the valuation should not be on a consolidated basis of portfolio of shares in 5 companies. Rather, the valuation should be on an investment by investment basis, not on a global basis. So as we already discussed, any decline to fair value or any reversals is recorded in profit and loss account. So let's say we have already discussed for the treatment of 20,000 rupees. So when the fair value is less than cost, so it has been debited in profit and loss account. Now coming to the another example. So let's say in the next reporting date, again it is a current investment. In the next reporting date, the fair value of these Infosys shares will become 1,10,000. So the 800 will grow up to 1100. So now the cost is 1 lakh and the fair value is 1,10,000. So we cannot go beyond cost. So we have to recognize, or we have to carry the investment at 1 lakh rupees. So whatever earlier 20,000 will be debited in profit and loss, now it will be credited as a mark to market gain in profit and loss account. So the basic idea is the subsequent recognition, the subsequent measurement is at lower of cost and fair value. Now coming to long-term investment. So long-term investment will always be carried at cost, because the intention of keeping those investment is on a long-term basis. So the market fluctuations should not be recorded. The market fluctuations will only be recorded, I mean to say the lower will only be recorded as a provision for diminution when the decline in the value is permanent. So provision for diminution made to recognize a decline other than temporary in the value of investment. Let's say the entity A has invested in equity share of entity B. Entity B is continuously making losses and its share is continuously going down in the market. So in such case, entity A has to record the shares at a fair value, and entity A has to provide a provision for diminution. So it should be at cost less provision for diminution. So entity has to recognize a provision for that. Again, such reduction should be determined on individual investment basis and not on an overall global basis. I mean to say, let's say entity has invested in five in five securities of in five securities of five different companies. So one company is incurring losses and rest four company is doing good. So entity has to value those investment. Entity has to determine the valuation of those investment on a particular investment basis, not on a overall global basis. So going by globally, let's say the entity was having a portfolio of 10 lakh rupees and the overall portfolio, the value of overall portfolio is 11 lakh rupees. So prima facie the entity is making money, the entity is in profit. So entity has to recognize that cost, but it is not correct. The entity has to look from the angle of a single investment basis. So if investment A is incurring a losses, then provision for diminution will be made, and if B, C, D, E is making profit, then it has to be carried at cost only. So like current investment, any decline to fair value or any reversal will be recorded in profit and loss account. Now coming to investment property. So under investment property there are only two assets. Two assets means land or building which are not intended to be occupied substantially for use by or in the operation of the investing enterprise. So the key concept is, if the entity has made an investment in investment property for the purpose of earning rental or for the purpose of capital appreciation. So basically the entity has acquired land and building not for using in its own operation or not for using in or let's say not for undetermined future use. So it is an investment in land or building which are not intended to be occupied substantially for use by or in the operation of the investing enterprise. So the entity is not running its plant, the entity is not running its office, the entity has not made a go down on that land and building for its business operation. Rather it is intended for some other purposes. It has acquired for purposes other than using for its own business. Then that investment in land or building will be termed as a investment property. And such investment property is always accounted as a long-term investment and it will be carried at a cost. Now coming to the next concept, disposal of investment. So far we have learned the meaning of investment, what is the form of investment and different form of income. Then we have learned the meaning of fair value and market value. Then we have learned and understand the classification of investment, when the investment is classified as a current investment and when the investment is classified as a long-term investment. Then we have dealt with the concept of cost of investment, how cost of investment will be measured, what should be included, what should not be included. So even we have touched upon the right shares criteria concept as well. So how the shares, how the investment will be accounted for when it is acquired X right and when it is acquired come right. We have also touched upon the concept of investment property. Now coming to disposal of investment. So till now we are only talking about acquisition of investment. Now we are talking about disposal of investment. So what if the company or the enterprise has sold the investments? So difference between the carrying value and the net disposal proceeds should be recognized in profit and loss account. So assuming the carrying value of the investment was rupees 1 lakh and the company has sold those investment for 1,20,000. So this 20,000 profit will go to profit and loss account. So considering vice versa, the value of investment was 1 lakh rupees and the company has sold those investment of rupees 80,000. So 20,000 loss will be debited to profit and loss account. In case of part disposal of holding, the carrying amount allocated to part is average of the total holding of investment. So let's say the entity is having a 1000 units of investment for a total value of rupees 1 lakh. But the entity is disposing 400 units. The entity is disposing 400 units. So in this case, so this 1000 units has been acquired at a different rate, let's say at the rate of 10 rupees, 9 rupees, 8 rupees, 11 rupees. So this 10,000 is a summation of securities purchased at a different time at a different rate. So while calculating the profit on sale of these 400 units, the carrying amount for this portion will be the weighted average amount. So it should not be on a FIFO basis, it should be on a weighted average basis. So the entity has to calculate or determine the weighted average price of this 400 units, this carrying value of 400 units, and this 400 units carrying value has to be compared with a disposal or sale price. The difference will go to profit and loss. So the key concept here is it has to be determined on the basis of average price. Now we'll understand this concept with the help of a case study. Mercury Limited has incurred following transactions during the year ended 31st March 2016. So on 15 January 2016, it has purchased 10,000 equity shares of rupees 1 each in Mars Limited at a price of 1 per share and include a brokerage of 5%. So the price is 10,000 multiplied by 1 is equal to 10,000 and 5% is brokerage cost. So the cost of investment for 10,000 unit is 10,500. After 1 month, that is on February 15, 2016, it has purchased another 20,000 equity shares of rupees 1 each in Mars at rupees 1.50 per share. So after 1 month, the price has gone up and the entity has purchased 20,000 shares at the rate of 1.5. So the cost is 30,000 rupees. On March 30th, 2016, the entity has sold 5,000 equity shares at rupees 2 per share. So on 30th March, the entity has sold 5,000 shares. So the entity is having a portfolio of 10,000 plus 20,000, 30,000 shares. And out of the portfolio of 30,000 shares, the entity is selling a portion of 5,000 equity shares at the rate of rupees 2 per share. Selling expenses incurred were 200 on this transaction. The market value of shares of Mars Limited as on 31st March 16 were 1.25 per share. Calculate profit incurred on sale of shares and value of closing investment as at 31st March 2016. So here on 15 January 2016, the entity has purchased 10,000 units at a cost of 10,500. On 15th February 2016, the entity has purchased 20,000 units at a cost of 30,000. So the entity has incurred a total cost of 40,500 on 30,000 units. So entity A has sold on 30th March 16, entity A has sold 5,000 units at a price of 2 rupees and incurred expense of 200 rupees, a selling expense of 200 rupees. So the total is 10,000 minus 200, it is 9,800. So the selling price is 9,800. Now the weighted average cost for this 5,000 unit is 40,500 divided by 30,000 multiplied by 5,000. So this will comes out to 40,500 divided by 30,000 multiplied by 5,000. So it is 6750. This is weighted average price or average price cost. So the entity has made a profit of 3,050 rupees. Now the closing value of the portfolio for 25,000 units at the rate of 40,500 minus 6750. So it is 33,750. So the per unit price is 33,750 divided by 25,000 is 1 rupees 35 paisa each. Now in this question, the question is telling that the market value of shares as on 31st March, the closing value is 1.25 per share. So calculate profit incurred on sale of shares and value of closing investment. The question is also asking for value of closing investment. So assuming it is a current investment, it has to be carried at a lower of cost or fair value. So fair value is 1 rupees 25 per share. So 25,000 multiplied by 1.25 is equal to 31,250, but the carrying value is 33,750. So the entity will recognize a mark to market loss in its P&L account for 33,750 minus 31,250. So it is 2,500. So the entity will value the closing investment at 31,250 and recognize the MTM loss in profit and loss account for 2,500 and recognize a profit of 3,050 for selling a portfolio of 5,000 units. I hope now you are able to understand the concept in case of disposal of investment. Now reclassification of investment. So there are two classification. One is current investment and long-term investment. So current investment are those investment where when it is readily realizable and intention is to hold for less than a year. So when an entity is reclassifying its long-term investment to current investment, so in that case it has to be recognized at lower of cost and carrying amount. So let's say the long-term investment was carried at a cost of rupees 1 lakh. So the carrying value is 1 lakh rupees and the cost is 1 lakh rupees. So it has to be recognized at lower, but in this case both are 1 lakh rupees, so it has to be recognized at lower. But suppose the cost was 1 lakh rupees for long-term investment, but the carrying value is 80,000 rupees. So in this case it has to be recognized at lower value, which is 80,000 rupees. Coming to the another example, current to long-term investment. So if the entity is reclassifying its current investment to long-term investment, in this case the entity has to recognize the long-term investment at lower of cost and fair value on the date of transfer. So let's say the entity is reclassifying its current investment to long-term investment on 1st October 2016. So the entity has to determine what is the fair value or what is the market value on 1st October 2016. And entity needs to compare the fair value on the date of transfer with the cost price of that investment and has to recognize the long-term investment at a lower of cost and fair value.